The S&P 500 has gained about 9% per year over the past 30 years versus about 4.5% price appreciation in real estate. Now, stock market aficionados in the conversation there, but in this video, I'm going to show you that real estate over the same time period has outperformed the stock market by over 160%. Let's say you invested $20,000 in the stock market 30 years ago and you just held it. What would your investment be worth today? So assuming a compounded annual growth rate of 9%, your investment should have grown to about $195,000. But you're also going to be gaining about 2% on your investment per year in dividends. This is going to add an additional $55,000 to your investment. With the inclusion of the dividends, this brings the total value of your investment to about $250,000. Now that's a great return, but how does it compare to real estate? What if you had used that $20,000 as a down payment on a $100,000 house? Now, with a little over 4.5% price appreciation over the past 30 years, at the end of this 30-year time period, the house is going to be worth about $350,000. Now, if we assume that rent in 1993 was about $450, you're paying a little over $1,000 now, you should have collected over this 30-year span about $375,000 in rents to bring the total value of the investment to $725,000. Now, it would be excellent if we could stop there, but this 725 is a gross number because there are expenses involved with owning real estate. So let's assume that you paid an average of 6% and a 30-year mortgage. The cost of the house is actually going to be about $210,000. Now, if we assume about 30% expenses of your total rent roll, then we're going to take another $110,000 off. And that brings the net value of your investment to about $405,000. With a total return of more than $405,000 over the 30 years, and compared to the $250,000 return that you got in the stock market, real estate actually outperformed the stock market by a factor of 160%. You often hear people compare the stock market versus real estate in terms of the compounded annual growth rate versus their average price appreciation. But as you can see in this example, it doesn't tell the whole story. And this entire analysis completely ignores the tax benefits that go along with investing in real estate.